The other day, I had a friend who is trying to acquire two different summer and winter resorts, right, outside of the US. And he was trying to identify, is this a good deal? Is he overpaying? What is the biggest risks associated with it? We sat down, right? We run the numbers. We look at one of the companies, it's a public company, the other company is private. We run the numbers on the public company. What you really want to focus and what you really want to understand, right? You have to have an idea. What are the assets of the company, right? Could be hotels, could be commercial infrastructure, which could be areas where people have stores, people have food courts, right? You rent out all these locations in the resort, and this is all come down as part of your commercial space for rent. This is a revenue source of your resort, right? On the flip side, you also have a chain of hotels which are inside the resort. Uh, as a matter of fact, majority of the liabilities of this resort are actually coming from hiring, employment benefits, maintenance of the buildings. Because as you know, if you run a hotels, all of these hotels they should have year-round water and electricity. You may not need to hire a full staff, but you still have to maintain the building, right? And also, we remember very well what happened with the building, with the condominium building in Miami, which essentially went to the ground, right? There was a structural issue whatsoever. So you understand that the book value of the public company, understanding the book value versus the value of just going on the open market, purchasing all the shares or making tender offer to acquire all the shares is your main comparison, right? Starting point to value the deal. Meaning, let's say a company, in this particular example, this resort has 1 million shares in circulation that could be bought or traded on the open market. Let's say this company has $20 a share at this very moment, market price. Let's say you want to acquire the controlling package, which will be over 50%, right? You want to acquire 51%. You want to buy this amount of shares on the open market times $20 at the current prices, right? So you get the number, and then the corporate law will allow you to make a tender offer for the remaining 49%. You combine both numbers, how much out of pocket will cost you to acquire 90 to 95% or 100% of the company versus how much is the company actually worth on the site, assets minus liabilities, which will give you the book value. So if it costs you to buy all the shares on open market, let's say 20, 30, $40 million, but the assets minus liability is giving you $100 million, well, you're buying a very, very good deal simply because if you close on the open market, tender offer plus buying up the remaining shares and acquiring to the public offering, you essentially ending up with $40 million upside, which is not yet profit because we all know there is a cost associated with the actual transactions. You most likely will need an investment bank to help you to essentially carry the deal, to broker the deal for you. You want to make sure that you have their own due diligence because sometimes somebody else has to look at the books. The books sometimes might be cooked. There might be different two ways of accounting, especially when we're talking about a company that is outside the US. So very important. This is your starting point. You don't have to be an expert, but you need to have your own idea and estimates of every single deal, where it makes sense, ballpark, and where it doesn't. Oh, obviously, one of the biggest schemes that no one actually talks about when you start counting your money, when you start trying to compute all the assets that you have minus liabilities at this very moment, trying to identify what is your actual net worth, is the problem of inflation. And inflation is your biggest enemy. It's not the price is going higher. It's not the taxes. It's not that some of your investments might not perform as you expect, might actually underperform the market, might underperform the treasuries, might underperform the passive investments, which could be in government paper or whatsoever. The biggest enemy remains inflation because you're not really fighting inflation. The only way to fight inflation is to stay out of cash and your cash sitting in assets which prices are going in the same direction with inflation. For example, if you have a portfolio of 10 cars, which are sports cars, which are, let's say, limited edition cars, one of 100, one of 300, etc., right? If these cars hit MSRP of $150,000 and you purchase one car and you purchase 10 more cars, you create a portfolio. Let's say you spend $15 million, right? Because inflation goes up 8, 10%, you no longer have $15 million portfolio of cars. Your portfolio now worth maybe 20, 25, $30 million. This is why inflation actually works in favor of the rich people who own assets. Rich people who simply sit in cash, they don't really benefit. They in fact struggle as the poor people because the asset appreciation is not there. In the beginning, AI was not even a thing, and in the end of this year, everything is AI. People no longer, even speak about crypto. If you look at all the positions that I have here, even on the forex markets, everything is closed. I have closed almost. I think I have only one open position on the stock market. I have four open on the crypto. The crazy part is that people usually overestimate the failure and underestimate the opportunities. Like they overestimate all the potential risks, everything that could go wrong if you really think about it. You try to start a business, the first thought you had is all the things that will not work, that you can't do, that you saw somebody else fail to do so, right? People are not looking into, okay, you know what? I actually have some experience in this. I actually might have being positioned in the best way to succeed in this because I know this, I've done this, or I work alongside people who have done this. Like I said, people are sabotaging themselves all the time. You know, I've seen people working the same job for like 3, 4, 5 years. They kind of like the job, but they don't see that the opportunity you can make more money, and they simply quit and shift to something else. And maybe 1.5, 2 years later, they see somebody on Forbes. He created a business out of this, and they kind of wonder, how is that even possible? Because they know they had experience, they know the industry, they know the business, but they simply didn't see the opportunity. Something that I just mentioned. Like I said, people usually overestimate all the risks. Like if you're going to pine for gold, you don't really think, oh, I'm not gonna find gold. You don't try to demotivate yourself. Why would you do that? If you really want to find gold, you're going to be optimistic. You're going to make sure that you give yourself the highest possibility chances. You're going to print all the maps, all the areas, all the research that has gathered together with the highest possibility of gold concentration in this particular area. And you're going to find all the tools that will give you the best chance to find gold. You're not going to go and, bring the least important tools or the least capable tools to help you find for gold, or you're not going to go in the middle of nowhere where there is no single study or research that has potential to has gold. People are usually sabotage themselves. It's like you're going to have an MMA fight, right? You don't think, I'm going to lose. Not quite. You just prepare yourself and you give 100%. That doesn't mean you're going to win. 100% is not guaranteed win, but it just gives you the highest possibility to actually achieve the success. Think about it. What could go wrong if you give 100%? That's an honest question. Think about it. A lot of people don't quite make it for two main reasons. They're either lazy to give the 100% or they don't believe enough to give the 100%. Because if you're lazy, you're not going to give 100%. And if you don't really believe that something could happen or will happen, you're still not going to give the 100%. People usually give the 100% only when they're completely sure that something is very certain. It is going to happen, right? It's like you're trying to approach a glass of water. You're very certain you're going to get the glass of water because it's very obvious. They have a full concentration. They're approaching the glass. They grab the glass, they pull back. But this is a very simple example. People are not that certain in important things in life, which is kind of weird. Because, planning and execution combined with giving the 100%, I don't really think that things could go wrong. Just think about it. If you really give yourself the 100%, and if you really focus on the opportunities, you may actually overstate the opportunities and understate the risks. Because what is risks, right? Majority of the risks are associated with luck. If you want or don't want to admit it, if you think deeply, there's a lot of luck involved in absolutely everything professionally, right? So if you just disregard the luck because you have nothing to do with, you cannot control the luck, and just focus on the remaining part of the equation, which is your input, like we said, 100%. You have a good plan. You do all the steps that gives you the best possible chance to do it, right? I don't think that uh, anyone can go wrong by giving the 100% and making the best plans and putting the time and work and maybe overstate the opportunities over the risks of failure.